Welcome to Personal Finance Deep Dives, where we help you make your money work for you. Today, we're doing more than just defining student loans. We're really aiming to cut through the noise, give you the strategic insights you need to truly master your college financing.
Absolutely. Whether you're just starting to look at applications, maybe recinching your repayment plan, or even exploring alternatives altogether.
Right. We want to uncover those crucial details that people often miss.
Yeah.
The things that help you avoid costly mistakes and hopefully find a bit more financial freedom down the road.
Exactly. For so many, higher education just feels impossible without some kind of financial help. And yeah, that often means student loans. But navigating it all, from borrowing to paying it back, it can feel incredibly complex.
For sure.
So our mission in this deep dive is really empowerment through clarity. Doesn't matter if you're thinking about applying, already have loans, or maybe you're a parent helping out. We're going to demystify the core differences. Federal versus private, get into how interest really works, and crucially, how you can use all this knowledge for your long-term financial health.
Okay, let's unpack this.
Yeah.
So, starting with the basics, but maybe with a bit more depth. Most people get that a student loan is money you borrow for college. And yeah, you pay it back with interest.
Right.
But what's often missed is how that money actually moves and the immediate implications. Covering tuition, fees, room, board, books.
Technology, transportation, all those necessary costs.
It's a lifeline, no doubt.
Yeah.
But the disbursement, how you actually get the money, is quite specific, isn't it? And that kind of sets the stage for everything else.
It really does. And it's interesting because unlike, say, a personal loan where you might get a lump sum, student loan funds are typically sent straight to your school.
Ah, okay. Each semester.
Or quarter.
Usually semester and quarter,
Right.
yeah. The school takes its cut for its tuition and fees.
Right.
Then, if there's anything left over, that balance becomes available to you for those other educational costs we mentioned. So you don't just get a big check up front.
Not usually, no. And maybe even more critically, you generally don't start repaying immediately. There's often that grace period.
It's a 6-month window usually.
Typically 6 months after you graduate, or if your enrollment drops below halftime. But that grace period can sometimes give a false sense of security about the total cost.
How so? Because interest might still be adding up.
Precisely. Especially with certain types of loans. We'll definitely dig into that more.
Okay, so that brings us to a really key strategic point. Not all loans are the same. Understanding the big difference is crucial.
Paramount.
We got the two main players.
Yeah.
Federal student loans from the U.S. Department of Education.
Great.
And private student loans from banks, credit unions, other lenders. Beyond just who offers them, what's the single most critical difference for our listener to grasp?
I'd say it boils down to a combination of borrower protections and how the interest rates work. That's the absolute core distinction. Federal loans, they almost always offer fixed interest rates, often lower rates, too, set by Congress. And importantly, they aren't based on your credit history.
So everyone gets the same rate for that type of loan that year.
Generally, yes, for that specific loan type in that specific year. Plus, they come with significantly more flexibility for repayment, like income-driven plans and even potential loan forgiveness down the line.
Huge benefits.
Massive. Think of them like government-backed safety nets, and they usually don't need a cosigner.
Okay. And private loans.
Private loans are a different beast altogether. They are fundamentally credit-based. Your eligibility, your interest rate, it all depends heavily on your credit score, your financial history.
And probably a cosigners, right? Especially for students.
Oh, absolutely. A credit-worthy cosigner is very often required, particularly for undergrads without much credit history. And critically, private loans offer far fewer borrower protections. Repayment options are less flexible. Forgiveness is rare.
So that raises the question you hinted at.
Yeah.
Why would anyone choose a private loan if federal seems so much better?
That's a really important question, and often it's less of a choice and more of a necessity.
Because federal loan limits aren't enough.
Exactly. The federal limits might not cover the full cost of attendance, especially at more expensive schools, or sometimes there are specific eligibility issues.
Gotcha. So my advice, and it sounds like yours too, is always max out your federal options first.
Absolutely. Before you even think about private loans, the federal protections and flexibility can genuinely save you from major financial hardship later.
Okay, so let's maybe break down those main federal types people might see.
Good idea. First, you have direct subsidized loans. Key things here. They're only for undergraduate students, and you have to demonstrate financial need.
And subsidized means?
It means the government pays the interest on these loans while you're in school at least half-time, during your grace period, and during periods of deferment.
Wow, okay. That's a huge cost saving.
It really is. Many people underestimate how much that saves. Then there are direct unsubsidized loans. These are available to both undergrad and grad students, and financial need is not required.
But unsubsidized means?
It means you are responsible for all the interest that accrues. Starting right from disbursement, even while you're in school, interest starts adding up immediately.
Okay, important difference. What else?
Next, federal direct PLUS loans. These are generally for parents of dependent undergraduate students, parent PLUS loans, or for graduate and professional students themselves, grad PLUS loans.
Right.
Like unsubsidized loans, interest starts accruing right away. Repayment can often be deferred while the student is in school, but that interest keeps piling up unless it's paid.
Got it. And consolidation. I hear about that.
Yes, federal direct consolidation loans. These let you combine multiple eligible federal loans into one single loan with one monthly payment.
Does that change the terms? Like interest rate?
It gives you a new fixed interest rate, which is a weighted average of the rates on the loans you're consolidating, rounded up slightly. The main strategic benefit is simplifying your payments without losing those important federal benefits, like access to IDR plans or PSLF.
Okay, that's a good overview of the federal side. Very helpful.
Which, again, should generally be your first stop.
Definitely. But if those limits aren't enough, or maybe you don't qualify for as much as you need, that's when private loans might enter the picture.
That's usually the scenario, yes. And with private loans, it's crucial to remember every lender is different. They set their own rules, their own terms.
And they're looking hard at your creditworthiness.
Absolutely. They'll scrutinize your credit score, your income, your existing debt compared to your income, that debt-to-income ratio. And, as we said, the financial strength of any cosigner is huge.
A better credit profile means a better rate, presumably?
Generally, yes. A lower interest rate, which can save you a substantial amount of money over the years, it really pays to shop around.
Do private loans have fees, like federal loans sometimes do? Origination fees?
Some might, but often private lenders build those costs into the interest rate itself rather than charging a separate origination fee. That's why comparing the annual percentage rate, or APR, is so important.
Ah, because the APR includes fees and gives a truer cost picture.
Exactly. It levels the playing field when you're comparing offers from different private lenders.
Okay, let's shift gears a bit and talk about that silent killer you mentioned. Interest. It's not just the amount borrowed, it's the extra cost over time. Can you unpack simple versus compounding interest? Why is this so vital?
This is fundamental and honestly where a lot of confusion happens. Most federal student loans, and many private ones too, use simple interest.
Yeah.
And simple interest means you only pay interest on the original amount you borrowed the principal. So if you borrow $10,000 at 5% simple interest, you accrue $500 in interest per year, nice and steady, assuming the principal stays at $10,000.
So the interest itself doesn't start earning interest. Sounds much better for the borrower, more predictable.
It is generally better and more predictable. Now contrast that with compounding interest.
Uh-oh.
Yeah. With compounding, you pay interest not just on the principal, but also on any interest that has already accrued but hasn't been paid.
So interest earns interest.
Exactly. It snowballs. Let's take that $10,000 loan again, but now at 6% interest that compounds annually. After year one, you've got $600 in interest. If you don't pay it, that $600 gets added to your principal.
So year two, you're paying interest on $10,600.
Precisely, not just the original $10,000. So your balance grows much faster. While simple interest is common for student loans, especially federal ones, some private loans, especially variable rate ones or certain situations even with federal loans, can involve compounding if you're not careful.
So you really need to read the fine print on your loan agreement.
Always. Understand exactly how your interest is calculated.
Okay, that makes a huge difference. What about interest capitalization? Sounds bad.
It can be a significant financial hit if you're unprepared. Capitalization is when that accrued, unpaid interest is officially added to your principal balance.
Making the snowball bigger.
Exactly. It formalizes the snowball effect. This typically happens after periods like deferment or forbearance, or very commonly when your grace period ends on unsubsidized loans.
Can you give examples?
Sure. Let's say you have a $10,000 unsubsidized loan, and during school and your grace period, you accrue $2,246 in interest that you don't pay. When repayment starts, that interest capitalizes. Your new principal balance is now $12,246.
Wow.
And from then on, your interest is calculated based on that higher amount. It significantly increases your total repayment cost over the life of the loan.
So the key is knowing when capitalization happens for your specific loans.
Yes, and if possible, trying to make interest payments during those periods, like in school or during the grace period on unsubsidized loans, to prevent that interest from being added to your principal. Even small payments can help.
Good tip. So once we actually start making payments, how does that work? Where does the money go first?
There's a standard order of operations. Your payment is typically applied first to any outstanding fees, like late fees or collection charges.
Okay.
Second, it goes to cover the interest that has accrued since your last payment.
Right.
And finally, whatever is left over after fees and interest goes toward reducing your principal balance.
So making extra payments really helps attack the principal faster.
Absolutely. Or, as we mentioned, making interest-only payments while in school on unsubsidized loans stops that interest from capitalizing and keeps the principal from growing. Both are smart strategies if you can manage them.
Great advice. But for many, that's tough while still in school or just starting out. What are the main repayment options once the bills start coming due, especially for those federal loans?
Federal loans really shine here with their flexibility. There's the standard repayment plan that's usually the default, fixed payments over 10 years, pays it off relatively quickly.
Okay, straightforward.
Then you have graduated repayment plans. Payments start lower and increase every couple of years, still over a 10-year term generally. Good if you expect your income to rise steadily.
Makes sense.
For people with larger loan balances, there are extended repayment plans. These can stretch payments out for up to 25 years. Your monthly payment is lower.
But you pay way more interest over time.
Way more interest, exactly. It's a trade-off. And then perhaps the most important category for many borrowers, income-driven repayment, IDR plans.
We hear a lot about those, like the SAVE plan.
Exactly. The SAVE plan is the newest big one, replacing the old repay plan. There's also PAYE, pay as you earn, IBR, income-based repayment, and ICR, income contingent repayment.
Yeah, and the core idea is?
The core idea is that your monthly payment is based on a percentage of your discretionary income, what you earn above a certain poverty guideline threshold, typically between 5% and 20%, depending on the specific plan and your situation.
Which can make payments much more manageable if your income is low or you have a large family.
Precisely.
Yeah.
And the huge potential benefit here is that if you make payments under an IDR plan for 20 or 25 years, depending on the plan and loan type, any remaining loan balance might be forgiven.
Okay, forgiveness. That's the magic word everyone hopes for. What are the real established paths to that, and what do people need to know? It seems complicated.
It can feel complicated, you're right. The most well-known program is probably Public Service Loan Forgiveness, or PSLF.
For government or nonprofit workers?
Yes, specifically for those working full-time for a qualifying employer government at any level, or 501c nonprofits. If you make 120 qualifying monthly payments on your direct loans under a qualifying repayment plan, usually an IDR plan, while working for a qualifying employer,
then the remaining balance is forgiven, tax-free.
Exactly. 10 years of payments and qualified employment. The other main path is through those IDR plans we just discussed. After 20 or 25 years of payments, the remaining balance is forgiven.
But that forgiven amount might be taxed.
Historically, yes. IDR forgiveness has often been treated as taxable income. There are some temporary exceptions currently, but it's something to be aware of and plan for long-term. And again, for private loans.
Forgiveness, basically.
Generally, yes. Repayment terms are set by the lender, and forgiveness programs are extremely rare, if they exist at all. Another huge plus for federal loans.
Okay, we talked about needing loans, but there are limits, right? You can't just borrow infinite money. How much can people realistically expect?
Correct. Federal loans have strict annual limits how much you can borrow each academic year, and aggregate limits the total amount you can borrow overall. These vary based on your year in school, whether you're dependent or independent.
Can you give a ballpark?
Sure. For undergraduates, the annual limits for federal direct Stafford loans might range from roughly $5,500 to $12,500 depending on dependency status and year. Aggregate limits are often around $31,000 for dependent undergrads and maybe $57,500 for independent undergrads.
Okay, and grad students?
Graduate students can usually borrow more via Stafford loans, maybe up to $20,500 per year. Plus, they have access to Grad PIL U.S. loans, which can cover up to the full cost of attendance minus other aid.
So you might need a mix of federal loans.
Often, yes. Private loan limits, well, they generally go up to your school's certified cost of attendance minus any other financial aid you've received.
But the key strategy takeaway here is,
Borrow only what you absolutely need. Just because you can borrow the maximum doesn't mean you should. Every dollar you borrow now costs you more later thanks to interest. Focus on necessary expenses, tuition, fees, housing, books.
needs versus wants. Okay, how do you actually apply? Is it a nightmare?
It's different processes. For all federal aid, including loans, grants, and work study, you start with the AF, the free application for federal student aid.
Do it every year, right?
Every year you want aid, yes. That form determines your eligibility for everything federal. Your school then uses that info to send you a financial aid award letter outlining what you qualify for. If you accept federal loans, you'll usually need to sign a master promissory note, basically your promise to repay.
Okay. And for private loans?
You apply directly to each lender, banks, credit unions, online lenders. They'll do that credit check we talked about, look at your income, possibly require a cosigner.
And shop around.
Definitely shop around. Apply to several private lenders to compare the interest rates and terms they offer you. Even a small difference in the APR can save you thousands over the loan's life.
Let's touch on a scary scenario. What happens if someone really struggles and just can't pay? We hear horror stories.
It's a serious situation with significant consequences. Missing payments leads to delinquency, and eventually your loan can go into default.
Which tanks your credit score.
Severely. Defaulting damages your credit for years, making it incredibly difficult to get approved for other loans, mortgages, car loans, or even rent an apartment, or sometimes get certain jobs.
And the government can come after you for federal loans.
They can. The government has strong collection powers for federal loans, including garnishing wages, seizing tax refunds, and even taking portions of Social Security benefits in some cases.
Yikes. So the key message, if you're struggling, is
Communicate. Immediately contact your loan servicer, the company that manages your loan, and collect payments. Don't ignore the problem. They want to help you avoid default.
what can they offer?
They can explain options like deferment, temporarily pausing payments, though interest might accrue, or forbearance, similar, often for longer hardship periods. Or, crucially, they can help you get into one of those income-driven repayment plans, where your payment could potentially be much lower, even $0 per month, if your income is low enough.
So options exist, but you have to be proactive.
Absolutely critical. Don't wait until you're already in deep trouble.
Okay, that's sobering. But what if someone wants to minimize borrowing from the start or avoid loans entirely? What are the best alternatives? The free money options.
Yes, and pursuing these aggressively should be strategy number one for everyone. First up, scholarships.
Money you earn, not borrow.
Exactly. Based on academics, talents, sports, background, essays, you name it. The key insight here, don't just look at the huge national scholarship.
So competitive.
Very competitive. Focus also on smaller local scholarships, community foundations, parents' employers, religious groups, clubs. Fewer applicants often means a much better chance. It takes time to apply, but the payoff is huge money you don't repay.
Great point. What else?
Grants. These are typically need-based aid, often from the federal government, like the Pell Grant, or state governments, or sometimes the colleges themselves. Like scholarships, grants are gift aid, no repayment needed as long as you meet the requirements.
FSA is key for federal grants too, right?
Absolutely. FS is the gateway for federal grants as well as loans. And finally, work-study programs.
Getting paid to work on campus.
Essentially, yes. These programs offer part-time jobs, often on campus, allowing you to earn money to help cover educational costs. Plus, you gain work experience. Some are federally funded based on need determined by the AFSA. Others are funded directly by the school.
So, scholarships, grants, work study, pursue these relentlessly before thinking about loans, or at least to minimize the amount you need to borrow.
That's the ideal strategy, 100%.
Yeah.
You know, at the end of the day, really getting a handle on how student loans work, the different types, how interest behaves, your repayment choices, and especially these alternatives, it's just paramount.
It's not just about getting the money for tuition.
Not at all. It's about making informed financial decisions that are going to echo through your financial life for years, maybe decades. Choosing federal over private when possible, understanding capitalization, aggressively seeking free money. These choices can literally save you thousands and give you so much more freedom after graduation. It makes you wonder, What if really robust financial literacy training, specifically about college costs and loans, became just as standard a part of the college application process as writing the essay, before anyone signs on the dotted line for a loan? How might that shift things for future students and their long-term financial well-being?
That's a powerful thought to end on. Really makes you think. That's all for now, folks. Please like, share, and subscribe for more like this.